Welcome to another edition of pizz-spectives. My name is Pizzichetta, founder of Mont Wealth. And today we're going to talk a little bit about how the power of 1% and compounding, but also how the next decade will be harder and how you need to be focused on your investment strategies and take a little bit more control on how your capital is invested, both personally and via your superannuation funds. Now, there are two kinds of pain in investing: the pain of discipline, making hard decisions, challenging your assumptions, and reviewing your strategy, doing the work when it's uncomfortable. And the pain of regret, sitting at 65 and realizing the retirement you planned and the retirement you can afford are not the same thing. Before we get started into the detail, the general advice disclaimer: anything we discuss today is general advice only. Anyone acting on this advice without written and agreed consent does so entirely at their own risk. Now, today's episode is one of the most important we've done, because it addresses a structural shift happening beneath the surface of markets, a shift that most investors are not positioned for, a shift that if you don't act on it, it will cost you quietly, slowly, and it compounds. So what we're covering today is why returns are structurally lower going forward, why inflation is more persistent than most people realize, and why passive investing alone is no longer enough. We're positioning portfolios at Mont Wealth to navigate this new regime, and we're going to talk you through that. I'll also bring in the macro framework Chris Joye from Coolabah, who we met recently, whose analysis has been one of the most clear-eyed and challenging perspectives we've encountered. It adds and confirms our investment committee's thinking. Let's get into it. For the last 10 to 15 years, investors were handed an extraordinary set of tailwinds: falling interest rates, low inflation, expanding equity valuations, massive central bank liquidity pumping through the system. That combination delivered exceptional returns across almost every asset class. A passive index fund, a growth option in super, set and forget, it worked. The rising tide lifted everything. The AFR reports during the week that ETF growth from millennials and Gen Z continues to grow due to convenience and accessibility. They are the core fundamentals for a sound investment strategy. Joke. But the regime is now behind us. Our capital market assumptions, reinforced directly at the investment committee, project global equities return to 7 to 8% going forward. Compare that to 12 to 30% historically. Bonds are more volatile and far less reliable as diversifiers, and critically, listed asset classes are more correlated than they were a decade ago. When everything moves together, diversification through traditional means loses its power. As we said in the committee, that's exactly why alternatives matter more now than they ever have. And here's the uncomfortable truth I want you to sit with. This is not a temporary blip. This is a structural change. The conditions that created the last 4 decades and all that we think we know are not coming back in the near term. And if you're still running the investment strategy of the previous cycle, you're operating in the wrong gear for the road you're actually on. Let me bring in some of Chris Joye's framework, because this is where things get genuinely confronting. Joye makes an argument that most investors are not ready to hear. AI, the technology everyone is betting will deflate costs and supercharge productivity, he argues, is actually inflationary. His words: it's massive spending, demand, and employment shock. Think about what we're actually seeing. Hyperscalers committing hundreds of billions in capital expenditure, an intense competition for scarce inputs, chips, energy, commodities, specialized talent, strong employment growth across the sector. That's demand-side inflation, not deflation. Layer on top of that, core inflation in the US has been persistently running above target. Even while the Fed has been cutting rates, that's a dangerous and deeply unusual combination. Strong growth, persistent inflation, and mispriced interest rates. And here's where Joye lands, and this should be getting your attention. Asset prices are not embedding any risks of a rate hike. He believes we could be entering a synchronized global hiking cycle, a second one. That is a completely different world to what investors have experienced and built their strategies around. And if Joye's right, the reset in asset valuations that comes with higher for longer rates is not priced in, and the portfolios built for the old world will take a hit. Now, Joye's view on Australia is even more confronting. He reduces Australia's inflation to just 2 drivers: government spending and immigration. Both are still elevated, both are structural, not transient. At the same time, we're in per-capita recession. Housing affordability is stretched to historic limits. Household debt levels are rising, and Joye's base case has the RBA cash rate drifting toward 5 to 6%. If that scenario plays out, house prices fall, defaults rise, credit stress increases, and Australia's growth model, which is being propped up by population growth and government spending, begins to break down. Now, I'm not here to tell you the outcome is certain, but I'm telling you that your portfolios are prepared for that possibility. You are taking on risk that you may not even know you're carrying. So let's bring this back to you personally, because this is where strategy meets real life. Take a 40-year-old starting super balance of $250,000, contributes $2,000 per month as part of a superannuation contribution for the next 25 years, and plans to retire at 65. At 8% per annum, a return consistent with the previous cycle, an investor retires with $3,532,000. $3,532,000. Now drop the return by 1%, 7%. Same person, same contribution, same discipline, same 25 years. Retirement balance, $2,924,000. I'll repeat, $2,924,000. The gap is $607,000. 1 percentage point, $600,000, compounded silently over 25 years. And here is the thing that makes this insidious. In years 1 through 10, the two curves look identical. You feel like they're on track. Everything's fine. It's not until around year 15 that curves begin to visibly separate. And in the final 5 years, the divergence becomes dramatic because compounding is exponential. The last years do the heaviest lifting. And if you're running 1% below where you should be, those final years don't deliver what they need to. By the time the gap is visible, it's too late to close it. This is the pain of regret, and it is entirely avoidable. Passive investing was built for a specific set of conditions: high liquidity, low dispersion between assets, mega cap dominance driving index returns. We no longer live in that world. Today, dispersion is rising, macro volatility is higher, sector rotation is accelerating. The concentration risk embedded in passive global equity indices is extraordinary. The top 10 stocks of the S&P 500 represent about 35% of the index. When you buy a passive global equities fund, you are taking a massive unhedged bet on a handful of US technology companies, whether you choose to or not. That is not diversification. That is concentration risk with an index label on it. Don't get me started on the ASX 200. 4 bank stocks make up almost 30%. One resource stock is 10%, and the next best 3 add another 10%. 8 stocks, almost 50% of the index. Banks need economic, credit, and population growth. They are its only levers, while they spend billions on improving their technology platforms. As we discussed in the committee, active managers are protecting better in this environment. They're managing risk more efficiently and effectively, and critically, the payoff to active management varies and timing matters. Active management is not about constant outperformance, it's about selectively adding value when dispersion is high and risk management matters most. Right now, dispersion is high and risk management matters. I want to be direct with you now because this is the part of the conversation I think matters most. The passive philosophy, the idea that you just sit in your super, pick a growth option and trust it'll be fine, that philosophy was built for a different world. A world of falling rates and rising multiples, a world where the market did the work for you. That world is gone. And so too many investors are sitting in strategies that were collaborated in conditions that no longer exist, waiting for someone else to tell them to act, waiting for the annual review, waiting for the headline that says things have changed. Here's the headline: things have changed. The investors who will retire with security and freedom over the next 25 years are not the ones who have hoped for the best. They are the ones who took ownership, who decided that their retirement was too important to be left to default settings and passive assumptions. There is a quote I come back to often, and it's simple but it's true. You will feel the pain of discipline or the pain of regret. You don't get to avoid both. The discipline is this: review your strategy, understand your allocation, ask hard questions, engage with your advisor, and make deliberate choices. The regret is this: arriving at 65 and doing the maths, realizing that $600,000 wasn't lost in a crash. It was lost gradually, silently, because no one made a decision. You get to choose which pain you experience. Choose discipline, choose now. So what does this strategy look like for us? At Mont Wealth, we've been deliberate and specific in how we've built strategic growth portfolio in response to this environment. The allocation sits across 4 pillars. Shares are at 39%, not the 70 or 80% you see in traditional growth funds, because equity reliance alone in this environment is a risk. Bonds and cash at 20%, finally offering a real return after years of near zero yields. Alternatives at 25%, providing uncorrelated return streams through gold, a little bit of Bitcoin, and other non-traditional exposures. And real assets at 15%, which include infrastructure and property, providing inflation linkage and structured demand that listed markets simply cannot replicate. Across those pillars, 5 structural themes shape our thinking. First, reduce equity reliance. We're not dependent on equities alone to generate returns. That's a deliberate choice. Second, diversified income. Private credit, infrastructure, real assets, income streams are not correlated to each other or to listed market volatility. Third, uncorrelated assets. Gold, Bitcoin, and alternatives. These move differently. In a world of higher correlation across traditional assets, that difference is worth a great deal. Fourth, real assets for inflation protection. Infrastructure and property provide earnings growth with inflation linkage. And in Joye's world of persistent inflation and potential higher rates, these assets earn their place. And fifth, dynamic allocation. We actively adjust positioning across equity exposures, real assets, private credit, private equity, and bond allocation. Because in a macro environment, this is volatile. Statistic positioning is a liability. As I said in the committee, the portfolio is balanced across defensive and growth levers. That's what allows you to perform across different environments, and that's what allows you to sleep at night. So the next decade will be harder, not catastrophic, just harder. Returns will be lower, inflation will be more persistent, volatility will be higher, and dispersion will create both opportunity and risk. 1 percentage point of return difference will cost a 40-year-old investor over $600,000 across 25 years. That is the mathematical reality of the environment we are moving into. Passive alone is not enough. Default settings are not enough. Hope is not a strategy. What is enough is ownership. It is taking control of your investment strategy with the same seriousness and intentionality that you bring to your career, your business, your family. It is choosing the pain of discipline over the pain of regret. The investors who thrive in the next decade will be the ones who look at changing world and made a decision. Not a perfect decision, not a complex one, just a deliberate one. Review your allocation, challenge your strategy, take ownership. Because your future self at 65 is counting on the decisions you make right now. I'm Pizzichetta. If you'd like to be added to the distribution list, head to the website, montwealth.com.au, and register your details there.